Assalamualaikum and hi everyone. I'm Madam Yusnalisa. Welcome to my channel. Today's presentation, we are going to learn how to prepare the consolidated statement of financial position, and we are going to use the question FAR320 July 2021, and this will involve preparation that will be for simple group structure, group with a fellow subsidiary. So that is the situation. Let us look at the question. This is the question. Question 1. It is about Aman that acquires a business called Sentosa. So he invested in Sentosa to expand the business. And these were the statement of financial position of the separate company, Aman and Sentosa, as at 31st of December 2020. And 31st of December 2020 is the current financial year end. Current financial year end. That will be the date that you will prepare your soft pay. Okay, so here is the information on the acquisition. The first one is information on ordinary shares that you have acquired, and this is the consideration transferred. The second information is on the acquisition of debenture. This one, debenture, where you acquire 12% debenture and the consideration transfer is 250,000. And if you look at the bottom here, these are the debentures available in the subsidiary, which is at the carrying amount, and you acquire some portion of it. The information is at the bottom there. You will see that later. And at the same time, for the ordinary shares, you acquire, here is 2.7, not all, but you acquire to give you the control. We'll check that. We need to also look at what is the fair value, how much. So you need to go and check if the units and the amount is the same. That will be checked at the bottom here. So if you look here, what you acquired to get the control on the date of acquisition, which is 1st of January 2020, it was actually gives you a control because 1.62 divided by 2.7 million, that will give you the percentage would be 60%, the holding percentage. So the NCI would be 40%. Right, that was for the acquisition of ordinary shares. And if you look, you have other information, and when you acquire the ordinary shares, this will be eliminated. Same as goes for the acquisition of ordinary shares here. This will not be reported. It will just report just the one of the parent company. And you would also notice that debentures you will still report because part of this are being acquired and remaining belongs to the debenture holder. That was in second information. So second information is to be discussed in a short while. But before that, you have one more information on the shares, but this time is the redeemable preference shares, and you have no information actually telling the acquisition. So if you check here, none, it was just on shares and ordinary shares and debenture. So here means the 100% belongs to the NCI. So there are no percentage acquired by the parent company. On this date, what is more important is also you are informed on the reserve balances on the date before the adjustment took place. The balance at the end of the current year was these balances. So let us look at the remaining information, and what we are going to do is we're going to look at the requirement at the bottom here. First, we are asked to calculate goodwill. We'll do things to calculate goodwill or bargain purchase, and this would be for both ordinary and the debenture. We'll do that, and then we will prepare a schedule to show the non-controlling interest, retained profit, and other reserve. And other reserve in our case here would be the general reserve as at 31st of December, and the analysis of the reserve and the equity section analysis of the financial statement. And then lastly will be to prepare the requirement, which is consolidated statement of financial position. So you need to prepare all this to get this 25 marks. And then you would notice later at the bottom here, right, this is the important information on the date of acquisition, retained profit and general reserve, 100,000 and 120. This too is referring to the pre-acquisition reserve. Pre-acquisition reserve is the reserve existing on the date of acquisition. This is the date of acquisition. So you have to reserve, make sure to include that in the net asset on the date of acquisition. So that has to be included in the calculation of goodwill. At the same time, you are also informed on the information regarding the net asset of the subsidiary on the 1st January that was stated at their fair values. All of them, with the exception of a building, that the fair value of the building is now more by 200,000 than its book value or the carrying amount. So therefore, if the fair value is more than the carrying value on that date of acquisition, this is a surplus, revaluation surplus, and this will be credited to the ARR, but asset revaluation reserve here will be asset revaluation reserve relating to the building of the subsidiary, and the surplus is 200,000. And in terms of journal entry, because this arrives on the date of acquisition, you will debit building of the subsidiary and you will credit the asset revaluation reserve. The pre-acquisition balance of the subsidiary will have to be adjusted, and on the day of acquisition no adjustment has been made, so we need to reflect the value, so we go and reflect that by adjusting our building to the fair value. How much we need to check later, but the difference is a surplus, then this will be reflected in the net asset or equity. On top of that, when there is a surplus, this will give rise to under provision of depreciation by who? By the subsidiary. So therefore you will have to go and debit the retained profit of the subsidiary Sentosa. I put Sentosa here, and you will credit because it was under provided, so there are no accumulated depreciation given here, so you will credit directly to the building that was shown at the carrying value. So we need to go and adjust directly to the building since there are no accumulated depreciation. How much will that be? There will be 200,000, and you need to check here there is a information regarding remaining useful life of 25 years on the date of acquisition. So this 25 years should be on the date of acquisition. So if it's on the reporting date, if it's here, which is current financial year end 31st of December 2020, so it would not be 25 years. If it's here, it would be 24 years, but it is actually here 1st of January 2020, so the RUL is 25 years. So the later it will be the shorter RUL. So therefore that will give you 8,000. That will have to be adjusted in the retained profit of Sentosa when you prepare the schedule. That will be relevant for our calculation of goodwill, so that's why we are doing that first. We also need to check if there is any bonus issue by the subsidiary out of pre-acquisition reserve. That will also impact the share capital here, but here no bonus issue. Check for bonus issue, check if you have bonus issue out of pre-acquisition reserve by the subsidiary. Next information here is on the information that happens on 1st of July. And on 1st of July, you have the acquisition of the debenture. So the acquisition of the debenture here, debenture 1st of July. You acquired 50%. So holding percentage is 50%. The other debenture holder percentage is 50%, and nothing relates to NCI because debenture is not equity. And that was done separately after 6 months, after the 6 months acquiring the ordinary shares, that both are all paid by cash for the consideration transfer. So what we can do now is we can prepare the schedule, and we prepare the schedule here to show the calculation of goodwill. Before that, this is the information on the acquisition percentage here. You can check here. Yeah, we can see that for the non-redeemable preference shares, the non-controlling interest is 100%. We start off by the acquisition of ordinary shares. Acquisition of ordinary shares would be 2494 in terms of consideration transfer. Then go and find out the fair value of the net asset. We do the simple things first, which is doing what will not adjusted the ordinary share capital, the general reserve pre-acquisition balance, and the retained profit balance on 1st of January 2020, the date of acquisition of the shares. Next is to include the revaluation that were taking place on the 1st of January to reflect the value of the building of the subsidiary. 200 is the surplus. Right. So now you can calculate the fair value of the net asset. That was 3120. And now that is going to be, your goodwill should be 622 because you are given the information somewhere in number 9. So you can go to number 9 and check that information. Here you can see the information number 9 is number 8, sorry, is on, sorry, it is number 9. I was correct already, so I just put it clear. So number 9, which is on the measurement of the fair value, the goodwill is actually partial goodwill because it is measured at the proportion of the fair value of the net asset of the subsidiary. Yeah, fair value of the net asset. So this is actually partial goodwill. And on top of that, just to remind you that the depreciation for this company, for all assets except for land that is not depreciated, they are all using straight line method, and it was adopting the yearly basis. How do I know yearly basis? Because it gives full year in the year of purchase and none in the year of disposal. Okay, so let's go and calculate the non-controlling interest. That was what we were doing just now. This is the non-controlling interest. You can see here, and you can see that in my schedule I have adjustment column, the goodwill column, the group retained profit column, the group general reserve, and the non-controlling interest. The one with the blue is non-controlling interest. So here is the calculation for the non-controlling interest, which is going to be 40%, which is a non-controlling interest percentage of the net asset. So that will give you the goodwill of course 622. And the next one is to calculate the goodwill for the debenture. First put the consideration transferred, then look at the percentage acquired. That was 50% from the carrying value of the debenture, so that means you acquired 250. So with that, there is no goodwill or bargain purchase, and the total goodwill now will be 622, which is the total goodwill coming from the ordinary and also the acquisition of debenture. So if you look at information number 8, if you can go to information number 8, you would see that there is some information about impairment. This one. So you are informed 10% of the goodwill were impaired as at 31st of December, which is the current financial year, and by 10%. So look at the date, it was at the end of the year. So that one means you are going to go and debit this to the group retained profit, which is the retained profit of Aman. How much? 10% from the goodwill. 10% is 10% from 622, and that will give you 62,200, and that would be credited to the goodwill on consolidation, 62.2. So that will have to be adjusted in the schedule later. So we'll be doing that straight away here. So if you can see here, the goodwill that is being impaired is was actually 62.2, and I put there in the column of the group retained profit because that will be debited. It means to reduce the retained profit of the group. So you can see there are columns here. That make sure you prepare the schedule in a organized manner. Right. This one is for the non-controlling interest on the date of acquisition. So the non-controlling interest would be 1248, which is the one here for the ordinary shares. And there is non-controlling interest for the non-redeemable preference shares, the one that was not acquired. So all 400,000 carrying amount of the shares in the subsidiary belongs to the non-controlling interest, non-controlling or the minority shareholder. Right. Next would be to look at the remaining adjustment. But before that, you need to go and put your reserve that you should include here. So one is the retained profit. So I start off with retained profit of the Sentosa, and you can put the balance to get 3 marks actually. So the balance is here from here. Yeah, you can take the balance here for the subsidiary, and this is for the parent. You can just put it there first, and you can have some pre-acquisition reserve figure that you have included here must also be adjusted so that we can find out what are our post acquisition balance. After that, we will have to include adjustment. So adjustment that will have to be done for the post acquisition period. Same goes here. You can put the figure for the parent, which is from the statement. For the general reserve, you can open up that and include that in the row, the figure for Aman, and also include the figure for Sentosa. You just do that first, which is easier for you to check, right? Easier for you to check. And what you will do is, now let us go to the last and the remaining part, which is in the question. Okay, information number 3. Information number 3 is on goods sold by Aman, by Sentosa. So this one, Sentosa is the subsidiary, Aman is the holding company. So when Sentosa sold goods to Aman, this is actually an upstream sales, and the seller is Sentosa. So the seller, Sentosa. So you need to go and look at what are any unrealized profit that you may have to eliminate. So you need to make provision for unrealized profit. In our case, the sale was 500,000, and the profit that was made on this sale was 100,000. That is important. And you are informed at the end 3/4 of the goods still remain unsold by Aman. So with that, it means that simply there is no sale, because we are not looking at the intercompany sale in the group financial statement. We are looking at the group result, which is the one by parent to the outsiders and the parent by the subsidiary to the outsiders. So therefore, for this 3/4 portion, we need to go and remove the profit that has earlier been recorded. So now it will be 3/4 from 100,000, which is the profit. So that would be 75. This would be debited to the retained profit of the seller, Sentosa, and it will be credited to the here inventory of the buyer, Aman. How much? By 75. That will be reflected in the schedule as well as in the soft P, C soft P. The next one is to also do adjustment for the amount owing. Amount owing here means unpaid amount by the subsidiary and parent here. If you can see, in addition to that, you are informed 90,000 of the amount was still owed to Sentosa. So Aman has not paid the goods, the amount owing, and therefore we need to go and eliminate amount owing by group members, right? By group member. So here you need to go and eliminate the account receivable, right? Under account receivable of Sentosa, you need to go and eliminate the one related to Aman, and under account payable of Aman, one of the supplier is the subsidiary Sentosa. So you need to go and remove the accounts payable and remove the accounts receivable. So in simple word, here debit accounts payable, credit accounts receivable. So that is because you have intercompany sale, right? So therefore, accounts receivable of Sentosa would be, we just put here the figure, that would be 90 and 90. And this will not impact the schedule, but this will be affecting the soft P, the asset and liabilities. So done with that. Next one is the intercompany sale of plant, and this is an intercompany sale of depreciable asset, and you need to go and make adjustment for depreciable asset, and here for the profit that has been realized. So since there are no information telling you about the plant being sold off by Sentosa to the outsider, you assume that has been still with Sentosa. So for the profit that has earlier been realized, so you now need to make provision to that to the unrealized profit, and the seller here is Aman. So you need to go and adjust who is the seller. Aman, right? So Aman is the seller. So go and debit to the retained profit of the seller. Seller here is Aman. This is 10,000. And you will credit to the item here is plant. So plant of the buyer, remember, buyer is Sentosa. I put here Sentosa. So 10. Next would be the adjustment for depreciation. Since this is depreciable asset, you are informed remaining life on the date of the intercompany sale of asset here was already given 4 years. So for that so-called intercompany sale at a profit, this will result in an over provision of depreciation. By whom? By the buyer, because buyer would have charged it depreciation based on a higher figure, and the seller would have charged it based on cost. So the over provision of depreciation by a buyer will have to be adjusted in the seller retained profit. How much? Debit retained profit. Sorry, this was an over provision, so we will not debit retained profit. We'll go and debit the plant. We need to go and decrease the depreciation in the retained profit of Sentosa, which retained profit of Aman. Aman is the seller. Aman, the seller. And that one would be, we do the working here, 10 divided by 4, which will give you 2.5 and 2.5, right? So let's look at this impact in our consolidated the workings. So before that, our first adjustment was to be done as well, which is related to the under provision for information number 1 earlier. And then adjustment number 3 is for the inventories, upstream sale by subsidiaries. And you also have the detail here, which is the one by the parent. They also need to do some adjustment during the post-acquisition period. One is the unrealized profit that has to be removed. And here is also for the over provision of depreciation. Right. So you are done with that. So let's go and do number 5. We will be doing the statement of financial position, the consolidation, the statement itself later. So we'll be doing this first, which is to look at information. Okay, information number 5 is regarding dividends. Before we start, the dividends that you have here is the one that will declare at the end of the year, where directors of Aman is the parent company, and also Sentosa is the subsidiary company, right? So both declared dividend, and the dividend that were declared by both company, ordinary dividend was 2%. 2%, yeah. So 2% for parent, 2% for the subsidiary. And for your information, since the parent company acquired the subsidiary, so there will be some portion that will have to be shared by the parent in the subsidiaries dividend. So what you need to do is, let us look at the ordinary dividend by parent first. By the parent, it will be 2% times the number of shares. It's not the case, but this should be this 7 million. No adjustment there. From 7 million, yeah, and this would be 140,000. So this would be debited to the retained profit of the parent Aman, and that will be credited to the ordinary dividend payable of Aman. How much? 140. The one by Sentosa is also the same. This is by Aman, and this is by Sentosa. Another 2%, but it will be based on 2.7, which is the shares in Sentosa amount. So that will give you 54,000. and that will be debited to the retained profit of Sentosa, credited to the dividend payable of Sentosa. We are doing number 5, and that would be 54. So you need to go and adjust the schedule. Yeah. However, out of these 54 that were declared by Sentosa, some of it will be an income to Aman. Aman is the parent company, and the income to Aman would be based on 60%. So therefore, first is that you will have to go and record this in the schedule, and then you need to also take note that the ordinary dividend payable by Sentosa, out of that 54,000, 60% belongs to Aman. And that would give a figure of, you need to go and check how much is the figure, but I've already done the some scribbling earlier. So that will be 32.4, and that will be credited to the retained profit of the parent company is Aman. So Aman will treat this as an income, and this is income from subsidiary that will not be reported in the consolidated financial statement. So that will be shown later in our consolidation when we do our current liabilities adjustment. Okay, that will be shown. Number 6. Number 6 is related to dividend paid by Sentosa. And remember, the non-redeemable preference shares were not acquired. So for Sentosa, I'm doing it here. You will see that dividend paid, that will be debit preference dividend payable Sentosa, and should be debit retained profit because it is declared from the profit. So debit retained profit of Sentosa, credit preference dividend payable of Sentosa. How much? That would be actually 10%, since the dividend is 10%, and the amount here is 400,000. So 10% for 400,000, and you were informed that was a full year dividend. So that would be 10% times 400 times 1 year. So that will give you 40,000 that you need to go and record in the schedule, right? So we have done with all the adjustment except for number 7. Number 7 would be the one related to bills payable of Sentosa. So if you look at bills payable of Sentosa, you will see it was 177, and if you check here, you are informed Aman has discounted 100,000 of the bills. So your point is to look at what is the undiscounted bill. So discounted is 100, so meaning that undiscounted is the remaining 77. So our consolidation adjustment will be based on this. So we need to go and eliminate the intercompany bills. So to debit the intercompany bills, debit bills payable of Sentosa, credit bills receivable of Aman with the undiscounted bills only. And that would be how much? We already calculated. That would be 77, which is 177 minus 100, the discounted portion. So that would be reflected in the this one is Aman, yeah, will be in the C soft P. So most of the thing we have done everything. So let's look at our question, and what we're going to do now is to complete the schedule. So let's complete the schedule. So information number 5 was on dividend. Take note, earlier I have already calculated this 54 in the subsidiaries, and information number 6 was also on dividend, and one is the dividend for ordinary shares, the other is the dividend for the preference shares, right? So those are for the preference and ordinary dividend. However, in the subsidiaries part, it was the case, but in the parent, if you look the parent, you would see that in the parent there was ordinary dividend payable, and at the same time there was some income from subsidiary, which is the one related to subsidiary, right? So that is this 54 multiplied by 60%. So the adjustment has to be done, consolidation adjustment. So we have done that. So most of the adjustment are being done here. So what we need to do is to complete the calculation. First, total up. So when you total up, you'll get the adjusted post-acquisition profit. Find out what is the amount belonging to the parent, which is 60% from 293, and what belongs to the non-controlling interest, that is 40% from 293. The same thing is for Aman, but Aman, you don't have any portion of whatever non-controlling interest because this is for the parent. So just take the one in the adjustment column and put it under the group retained profit column. This is where you are going to go and reduce the impairment with the impairment loss, so that will be debited against this profit figure, group profit. Next is to put the balance of Aman. Here there is no adjustment to the general reserve, so it will be just the same, right? We will have here in the general reserve column, make sure you put in the correct column, and that would also be for the case here is only for the parent. Let's look at the next one for the general reserve of the subsidiary. So the balance as per the SOP of the subsidiary was 120. The pre-acquisition balance was 120. So it gives no post-acquisition balance. So when there is no post-acquisition balance, there is no information or whatever share of the subsidiary into the parent company. Done with that? And you can now total up. This is the first total. This is the total for group retained profit, total for group general reserve, and this is the total for the non-controlling interest. Now let's look at the preparation of the consolidated statement of financial position in this part here. Okay, just make it bigger for you. Okay, so what you will do is first, if you can go back to your question, right, you will add up what you have here, as I have mentioned, this one, and bear in mind there was one item that was regarding debenture here. Take note on this. So let me just use a different color. I'm using one color that has not used yet. Okay, this color, which is showing you debenture interest receivable here with the debenture that you have here. So here is the debenture interest payable by both company, but what you need to take note is this portion here where 30,000 that was declared by the subsidiary, this has been already recorded by the parent. So this is actually situation where subsidiary has recorded, but the parent also has recorded. So this is situation 1. Both parent and subsidiary has recorded. Dividend has been interest has been recorded by the subsidiary. Parent also has taken credit of the share, so we eliminate later the intercompany interest receivable, which is 15. How do you know it's 15? This is actually 50% from the portion acquired on the debenture times 30. So that will not be reported, that debenture interest receivable. What you will report will be just 72 plus 30, but you need to go and reduce the 30 with 15. So that was situation 2. Let me remind you that in number 5 here, number 5, this was actually situation, the first one was situation 1. Yeah, here is situation 1. The second one here is situation 2. Situation 2 is where both parent and subsidiary has not recorded the dividend. So situation 2. So you need to go and identify the situation correctly. So that is for you to take note. And what we're going to do now, we're just going to add this. But bear in mind, general reserve, for the general reserve, for the retained profit, and for the non-controlling interest, that we will have to go and include one new item. This one would be from the schedule that we have earlier constructed. The 12% debenture will be first added, and then we will have to eliminate with the intercompany transaction. and also to recognize the unrecognized transaction. So let's do that here. First, just add the one that you have here. Just take the one of the asset, just add them first. Just do the addition. All this, just do the addition. Yeah, just include the debenture interest receivable first. Just add up the parent of and the subsidiaries that as per SOFP. Do not include the investment in the subsidiary, but please include the goodwill that were the remaining goodwill that was unimpaired, right? So you can do that first. For the ordinary shares, you just need to include the one of the parent company. The one of the subsidiary company will not be reported. Okay, and for the group retained profit and the general reserve, you already have the figure, which is from our workings earlier, our calculation in the schedule. Next would be to have your debenture. So for your debenture, first you can add all this, you can just add, okay, up till here. And remember to include the new item that has arisen in number 5 and number 6. For the ordinary dividend, first just include the one declared by parent and the one declared by the subsidiary. And also the dividends that were declared by the subsidiary from the preference shares, and then also the debenture interest as per the SOFP, just include that. What you need to do now is do the elimination. So elimination means you need to go and reflect what you have done. For example, the recognition of surplus and increase, where I put a note here, as per information number 2 must be reflected here. So what you say to be added means what you add to the debt, property, plant and equipment, for example, what you go and debit, and what you say to be reduced is what you credit. So here is about the increase in depreciation for the underprovision and also the surplus. This one is for the unrealized profit on the intercompany sale of the plant as well as the overprovision. And then here is for the unrealized profit, removal of unrealized profit. Account receivable here is to adjust for the intercompany amount owing, and here it's the total for this. And same goes here, bill receivable, adjust for the undiscounted bill. Remember we say debit the bills payable, credit bill receivable. So when you credit bill receivable, it means you need to go and remove them. Next is the debenture interest. You will see that first we report 15 here, right? And at the end there was no more. So in the parent section it was first 15 and now you minus 15, so there is no more because those are all intercompany transaction. However, if you have debenture interest coming from outsiders, yeah, which is not your subsidiary, you should report that. You must report. And next is the debenture here. So the elimination will be for the amount required by the parent, 250. We leave it with the 850, which is 600 plus 500 minus 250. And for the accounts payable, we eliminate with the amount owing. Bills payable, eliminate again with the same thing just now, that was the undiscounted bill. Ordinary dividend, you need to remove the income from subsidiary. Remember 2032.4, that shouldn't be reported. You report only dividend payable by the subsidiary to the non-controlling interest. So the one payable by the subsidiary to the non-controlling interest is 54 minus 32.4, or you can split this only dividend payable into two, one by subsidiary, one by parent. And then this is the one total for the subsidiary. For the preference dividend, none was acquired by the parent. And debenture interest payable, here we eliminate what was already credited by the parent, and therefore that would be 87. So the first total should be 12548.3, and this would be also the same. So if you can see here next to the information, I put to the amount, I put all the references related to the adjustment that we did, and I put some notes here. So you can also have a screenshot to see what was actually being shown in my workings, so that it is easier for you to see. So with that, I thank you for watching, and make sure that you go and check the video and watch it again. I'll see you when I will see you. With that, Assalamu alaikum and have a pleasant day ahead.